Welcome, folks. Welcome to another edition of the Heritage Wealth Planning YouTube channel. Today we're going to talk about fixed rate mortgages versus variable rate mortgages and what is best for you. There's a general rule of thumb that I've come to realize over the 20 plus years I've been a homeowner that I wish someone would have told me back when I started out buying houses in 1998. Essentially, if you think you're going to be in your house for more than 5 years, you should be in a fixed rate mortgage. Not every time, I get that. The situation will dictate. But generally speaking, the 5 years is a cutoff, a good rule of thumb for cutoffs. So let me give you an example that we did when we moved around. We bought our first house in Phoenix in 1998. 2002, we bought our second house in Virginia. 2008, we bought our third house in Texas. 2011, we bought our fourth house in New Jersey. In 2013, we bought our fifth house in Georgia, which is where we are today. Because we always took a fixed rate mortgage, because I'm pretty conservative in that regard, always worried about the risks, we've left an awful lot of money on the table. We paid an extraordinary amount of interest that we really did not have to pay if I would have even considered a variable rate mortgage. But I didn't. It seemed like too much risk. I remember it was like it was yesterday, signing the closing documents for my house in Phoenix in 1998, using a VA loan and getting 7% money. And I was thinking, man, I'm glad I'm locking this in because we'll never see money this cheap again. How wrong I was. And that literally has led me to, I've always thought that every time we bought a new home, I always said, oh, you'll never see money this cheap again, as the interest rates just went down and down and down. Now, that does not mean the interest rates can't go up and it can, bite in the bud if you do a variable rate mortgage. But we're going to talk about some examples I use here from the book to at least give you some background on what you should be considering as you choose a variable rate or a fixed rate. Either way, the facts are on the front end of your mortgage, the first 5 years in particular are just big time interest payments. You're paying a significant amount of interest relative to your principal. And so in a fixed rate mortgage, the interest is probably going to be maybe 2 to 3 to 1, $3 for every dollar of interest, $3 of interest for every dollar of principal, maybe 2, it depends on what the rates are. Whereas on a variable rate, if the rate is cheaper, and that's a big if, I don't know. Sometimes the variable rate mortgages can change, but if the rate is cheaper, you might actually be paying more principal on the first payment of your loan than you will interest just because the rates are so low. And that first 5 years really is going to, the amount of interest you pay relative to the principal, especially on a fixed rate mortgage, is incredible actually. And I want you to have that principal, that interest in your pocket as opposed to bank, especially if you think you're going to be in that house for less than 5 years. And just in hindsight, I wish someone would have told me this. Now, even though someone may have told me, or if they would have, that doesn't mean I would have heeded their advice. I've just been raised conservatively to watch my bottom line, what risks that are out there, which is why I'm a pretty good financial planner, because you always have the what if. But man, I just in hindsight look back, I said, I wish I had that interest. I could have used that, absolutely. So be advised. I'm telling you what no one told me when I was 27 years old or so, 28, I guess, when I bought my first house. 5 years. Think about it. Are you going to be there for 5 years? If so, a fixed rate looks good. If not, a variable rate looks good. So let's go over some numbers that I use in the book. Let me minimize myself here. Yeah. In this, I'm just using an example from Navy Federal Credit Union that they had in 2017. All right, so they were offering a 30-year fixed rate mortgage at 3.75%. 30-year fixed at 3.75. And I just chuckled because when I took my first mortgage at 7%, again, I never thought we'd see cheap money like that again, and look where we are today. Look where we've been for a long, long time. So in August of 2017, and I don't know what it's doing now. I do know this is March of 2018, the 10-year has gone up quite a bit, the 10-year Treasury bond, and that's usually the proxy for interest rates as a whole. So it went up from like 2.35 to about 2.8 is where we're at today. Typically, the 30-year bond is not quite as volatile as a 10, but certainly the 30-year bond is higher today than it was in August of 2017. So just bear with me here. The numbers that you see here certainly aren't going to be what you can get online if you go to NavyFederal.org and look today. But just as an example, this is what we were looking at when I was penning up my book, a 30-year fixed rate mortgage. So what I want to share with you is what a 30-year fixed rate mortgage would do after 5 years. And again, 5 years is a rule of thumb. And I'll explain that on when we talk about ARMs here, the variable rate mortgages here in just a second. But essentially, we're going back to Kevin and Brenda. And if you recall, they had a $200,000 house. They put $10,000 down, which meant their mortgage was $190,000. All right, so $10,000 of equity, $190,000 of mortgage debt. At 30 years, at 3.75, amortization table meant their payment was $880 a month. Okay, so they were paying $880 a month every month for 360 payments on that $190,000 home mortgage. That means after 5 years, they had total payments, if you go down here, of $52,795. So they paid $52,790, of which only $19,000 was principal, and $34,000 was interest. So basically a 2-to-1 ratio. For every dollar of principal, they paid $2 of interest. They started with $190,000 as a mortgage balance, and they ended with $171,000 after 5 years. All right, so that's a lot of money going out, and not that much reducing the principal. Now remember, the issue here was that Brenda had to take a significant pay cut, and again, I'll put I'll put a link to the video I did on that up here. And so they were going to take a job in a different state to reduce their cash flow, or to increase their cash flow and reduce their expenses. The problem they were having, though, was getting out from under that house because the fair market value of the home plummeted, but the mortgage value they still held did not. So the market value of the house was dropping, but the mortgage value was not, still at 171. The second drawback is they were living, basically they're breaking even cash flow wise, so they didn't have a lot of money to save, so they had no savings whatsoever. So that meant when it came time to sell their house, if they were upside down, which they were going to have to come up with some cash to get out from underneath it. They just didn't have any cash to come up with. So if they would have taken an ARM as opposed to a fixed, that might have been different. And let's show you what I'm talking about here. So just remember, they had a balance of $171,000 after paying $53,000 of payments over that time. So let's go here to my next sheet. All right, let me move myself up here a little bit. There we go. And so this one is what a 5-year ARM was looking at Navy Federal, and again in August of 2017. So at a 5-year ARM, or a 3-year ARM, 3 years, just 3 years, had a 1.875 interest rate for the first 3 years. Now, what an ARM is, an adjustable rate mortgage. So a 3-year ARM means that it's fixed for that amount of term, the 3-year in this case. They have 5-year ARM, they have 7-year ARMs, they have 10-year ARMs, they have 1-year ARMs. That number in front of the word, or the acronym ARM is how many years it's fixed for at that current rate. So a 5-year ARM or a 3-year ARM, a 10-year ARM at 3.875 or 2.875 or 1.875 just means the interest rate at that number is fixed for how many years for the adjustable rate mortgage, and then it can change. So in this case, we had a 3-year ARM at 1.875. So that meant it was fixed for 3 years. However, and this is where the risk comes that has always made me cringe. After 3 years, in this case for Navy Federals, the interest rate in year 4 could go up to 3.875, up 2% from what that was the initial rate. It could go from 1.875 all the way up to 3.875 in year 4. In year 5 can go up another 2 years to 5.875. And then in year 6, it can go to 7.875 where it maxes out. It can't go any further up than 7.875. But given where we are today and given where a fixed rate was at 3.75, the threat of it even being at 7.875 is quite frightening, which again is why the 5-year should be the cutoff for you. That should be your rule of thumb, how long you're going to be there. So in Kevin and Brenda's case, I said, okay, Let's just say we had an ARM. They did an ARM instead of that fixed rate, and they had good luck, which meant the interest rate did not change at all over those 5 years. What would happen? Again, they start off with $190, but instead of a payment being of $880 a month, their payments were $727 a month there, $726.80, which meant after 5 years, their total payments were $41,000, significantly lower. In fact, that's what, $12,000 lower than it was on the fixed. They paid $12,000 less than they did on the fixed rate mortgage. The interesting thing, though, is where the fixed rate mortgage, they only paid $1 principal for every $2 of interest. And here they basically paid $1.50 of principal for every $1 of interest, which meant not only did they pay $12,000 less in monthly payments, total monthly payments, but now they had $6,000 left of an ending balance when it came time for the 5 years to conclude. So they paid $12,000 less in total payments, which is money back in their pocket, and they had $6,000 less in the principal, which when they sell it is money back in their pocket. So they essentially netted a positive $18,000 relative to the fixed rate mortgage because they had good luck. Now I can hear you thinking, okay, well that's great, but what if the rates aren't so good? What if they don't have good luck? What happens then, Josh? Well, that's where I did a study on that too here. So this is worst case scenario. And again, worst case scenario is they are locked in at 1.875 for the first 3 years. Year 4 can go up to 3.875, and year 5 it can go up to 5.875. Okay, so after 5 years, the worst case scenario. Now again, we're not going into year 6, 7, and 8 because we're assuming that they're going to be out of their home in 5 years. But the worst case scenario for 5 years, well, let's take a look. Same thing, $190,000 is the principal initially, the balance, I should say. The first 3 years, the monthly payment is $727. But because the interest rates go up in year 4, increases their monthly payment to $874 and then again to $1,074 in year 5. And that's how it works. The bank re-amortizes the loan that you have. They take your ending balance or your beginning balance when the rates change. In this case, in year 4, the beginning of year 4, their ending balance is beginning balance is $175. Re-amortized it based on the current interest rates that you're paying, which meant their monthly payment went up from $727 to $874. Ending balance the beginning balance at the beginning of year 5, $171. The interest rate now is 5.875, which meant their monthly payment is $1,074, which is significantly higher, 20% higher than what the fixed rate was. But remember, this is the worst case. All right, so what happens? In this case, they paid $48,000 in total payments, which was $7,000 more than they paid in the best case scenario of the variable rate staying flat at 1.875. But it's $4,000 less than they paid in the fixed rate scenario, even though in year 4 and 5 they had a higher interest rate than they did in the fixed. Year 4 is 3.875, the fixed was 3.75, year 5 is 5.875, and the fixed was 3.875. But because they had such a low interest in the first 3 years, they still paid less in the worst case scenario over 5 years than they did in the fixed rate. Now, here is where it starts to turn, all right? The worm starts to turn a little bit. Here they paid $21,000 of principal against $27,000 of interest, okay? So they're paying more interest now, and you can see this, the reason why. Years 1 through 3, their principal is $14,000 they paid down against only $10,000 of interest. Year 4, the principal is $4,000 roughly against $7,000 of interest, and then look at that. Year 5, woo-wee, $3,000 of principal versus $10,000 of interest. So year 5, they're really getting, they're being taken literally to the bank. They're getting knocked around some, and that's where the 5-year thing really needs to be considered. At the end of the day, though, even under this worst case scenario, they paid $4,000 less, $5,000 less than they did in the fixed rate, and they still had $4,000 to $5,000, $4,000 less on their mortgage balance. So they still netted almost $9,000 more in their total net worth than they would have on the fixed. This is the worst case scenario. Which is why I bring to your attention, are you likely going to be in your home for 5 years? Think about it. Because if you're not likely to, and you take that fixed rate, you are literally, well, not literally, you are leaving money on the table that could go back in your pocket as opposed to the banks. And I caution you, especially if you're just starting out, because a lot of folks just starting out, they land that first job and they're thinking, yeah, this is what happened to us. And in hindsight, man, I just wish I would have known differently. And again, just because I would have known something doesn't mean I would have acted. But it would have been nice to have known so I could have at least thought the options through. I did not even consider a variable rate. Now, again, I have no clue what the variable rates were at that point. None. A fixed rate of 7%, I don't know. I don't even know what they are now, a variable rate relative to a fixed rate. What I would suggest, though, is that you crunch the numbers. Get yourself to have the bank run you amortization schedules based on worst case scenario relative to the variable rate mortgage you're considering versus the fixed rate mortgage you're considering. Look at it from a total payments. How much are you going to totally pay? Worst case scenario. How much of that would be total payments would be principal and how much of that would be interest. And then you'll know your ending mortgage balance on the worst case scenario on both scenarios there. And if the worst case scenario is significantly lower for you on a variable rate mortgage than a fixed, well, you got some thinking to do for sure. Now, if the worst case scenario is kind of a wash and you're not sold that you might ever move, it might be worth it to take the flyer on the fixed rate. If the rates do go down, you can always refinance. You're not stuck into that loan. The drawback about refinancing, though, I just want to be clear, man, it takes money to do that. It's not cheap. You got to do a title search. And for some reason, even though the same bank who just loaned you the money, they got to revisit the title to make sure, some guy from 1922 didn't have a claim to your property. But you're like, well, you did that when I bought the house to begin with. And that cost $2,000 just right there, even though they already got the title search done to prove that there's no lien on your property. And on top of that, there's an origination fee, there's closing costs, you got to get the appraisal done now, the attorney's got to come out, and a lot of this stuff can be done in your living room, but someone's still got to make the effort to come out and notarize your stuff, and that person isn't doing that for free. It all has a cost in there. And even if your bank said there's no cost, well, it's costing you something, or else the bank, as far as I can ever tell, has never been altruistic. Even credit unions, they got to make money. So at the end of the day, there is a cost that you're paying to refinance, and a lot of times it's not cheap. We're talking, the 5 figures easily. So keep that in mind. All right, share with me what your experiences are. Have you ever done a fixed rate? Have you ever looked in hindsight and say, oh man, I should have done a variable? Conversely, have you ever done a variable and got swamped because the rates went against you? It has to be a long time because the rates have done nothing but go down since 1982. There's a time there in 1994 where Greenspan was raising the rates, which really knocked the market around quite a bit, the stock market and the bond market. In 1994, there is some thought that might have even cost the Democrats control of Congress in 1994 because the interest rates are going up quite a bit. In 1999, the interest rates went up as well. That was right before the election of 2000, but that was pretty significant as well. And if you looked at the bond market when that happened in 94, then again in 1999, they both got crunched. And the interest rate cycle really turned against you, but quickly it turned back, or at least leveled off, I should say. It's probably a better term. It leveled off. It stopped pretty quickly. 1994 was pretty brutal, frankly. But we haven't had anything like that other than those 2 instances since literally 1982. If you look at 1982, the 30-year Treasury bond was at 15 and a quarter. All right, so you could buy a 30-year Treasury bond and you're getting 15 and a quarter. The last I checked, that was about 3 and a quarter. All right, now I don't know literally what it is today. I could probably look on my phone. I just don't feel like it. But that's how low the rates have gone over the last 35, 36 years. So not likely to happen that the rates spike up. Certainly not much more. It can go down, but that is a risk you got to consider. So put that in the comments. As I said before, give me a thumbs up. Turns out thumbs up are very helpful to me to get this YouTube channel exposed to other people who might not be aware of it. And then put comments in there. So like it, subscribe, hit that subscribe button down below. And of course, hit the bell for notifications. The notification sign just says, hey, I put more content out there, and you'll get an email anytime you log into YouTube. You'll see that it says a little red button on that notification bell that you have new content. So look forward to seeing the next Heritage Wealth Planning chapter. And if you have any questions, thoughts, or concerns, just put them down below. Thanks, guys. We'll see you.